Paul, welcome to the show. I'd imagine that the one that we're going to be closely or most closely watched this morning was going to be the retail sales. Can you talk to us about your thoughts and market reaction to the beat? It looks like it came in significantly higher than expected, 1.6%.
Yeah, I did, and across the board. So when you strip out autos, you strip out gas and everything else, you take a look at the core retail sales. They were certainly above expectations and on all of the levels that you look at. And so you saw a positive reaction in the equity markets, negative reaction in the bond market, positive reaction in the dollar, which is, again, as you mentioned, expected. And this now brings back into question, does the Fed stay on pause? You know, we've talked about now the implications for a rate cut later this year or maybe next. Does that come off the table? So when you're in this period of being data dependent, you get ping-ponged all over the place depending on whatever data point you're looking at. And so I think here what we're looking at and the expectations, certainly in the equity markets, have been that the first quarter is a throwaway quarter, and we're going to strengthen from here. And certainly the retail sales number points to that at this point. So, again, I'm not sure that the Fed is going to be on pause all the way through the year. And a few of the Fed governors had actually talked about maybe actually raising rates still this year. So there's still a few hawks out on the Fed chat circuit this week.
Well, and I mean, Paul, you can understand why when you take a look at some of the numbers that we're getting, jobless claims, for example, also pointing to a very strong labor market. I mean, you can see where these hawks are coming from. It's not completely misfounded. Really, it seems like the real concern continues to be Asia and continues to be international markets, specifically Europe, it seems like.
No. Absolutely. Europe is a mess. The PMIs that came out this morning in Europe were terrible. Yeah, they were terrible. Germany was down on the bottom. And Asia is interesting. You know, when you take a look at China, China has thrown a ton of money into their economy. Their central bank has done all kinds of, if you will, quantitative easing. And it's going to take a while for that to work its way around the globe. So if it is actually effective, we should see it probably in another 2-3 months showing up in some of the European data and maybe a little bit in the U.S. We're starting to see some early signs, at least, of it showing up in China. Again, kind of mixed results. If you look at electric capacity or electric output, which is kind of the shorthand version for Chinese growth, that's actually been a little bit weaker here. So that is one of the contradictory points to some of the stronger data coming out of China.
Paul, what does all this mean for the dollar? I mean, we've been largely stuck in a range since the end of March, 97.10 to 96.40 roughly.
Yeah, and even if you want to go back another 6 to 9 months, it's been a broader range, but we've been stuck at this upper range now for a while. Our call has been a little bit weaker dollar, but when you look at the global economy and you take a look at what we're seeing coming out of the U.S., it argues for a dollar that should be a little bit stronger here. So whether we break out of that range or not, I'm not quite sure. I think there's a lot of people looking at the Fed and looking at interest rates to kind of determine the direction for the dollar as opposed to the other way around. So keep an eye on the 10-year. If we continue to see some strengthening in yields, higher yields, you could see a dollar that continues to gain some strength here.
Paul, you know, one thing I noticed, and I'm glad you brought up the treasuries because I was going to talk about this in just a minute, but I wanted to get your thoughts on what does it mean to see open interest at these levels in the treasuries? I mean, it is significant. It's the highest we've seen all year, and in some cases, record highs.
No, it's true. And, you know, and again, it goes back to the narrative of everybody's anticipating the Fed to be on hold and actually cut rates. And I think really we saw the low in interest rates about 2-3 weeks back when we had the 5-day inversion of the yield curve. And so right now we've actually looked at rates that have been picking up. And I think that's been in reaction to a little bit stronger economic data. You know, when you look at the Citigroup strength data for the economic reports, I think we're bouncing off of a low, so we would anticipate the numbers going forward at least to be a little bit stronger than expected. So that could put pressure on yields here, and we could see higher yields, especially in the 10-year going forward. And again, that may start the discussion of gosh, maybe we should be talking about the Fed coming back into the picture later this year as opposed to staying away.
Yeah, I actually just pulled up a chart here. Our viewers are looking at the open interest on the Treasury markets. We're talking the longer dated bonds all the way through the 2-year. We can see it's been trending higher, Paul, to say the least. Let's talk a little bit about the jobless claims, because, again, retail sales coming in significantly higher than expected. I'd imagine this ties back to a strong labor market.
It does, and there's been some reports that some of the changes that have been happening at the state level have pushed down the weekly jobless claims a little bit artificial. But that being said, you're still looking at numbers, even with that backed out, that are at multi-decade lows, and we are seeing a little bit of wage pressure in the monthly jobless claims numbers. So again, we'll be watching that when we get to it early in May. So again, that could put more pressure on the Fed to be raising rates as opposed to cutting rates, which is really what everybody's expecting at this point. And you're seeing it in the numbers for the treasuries here.
Paul, I've backed a couple of my guests into a corner with this same question. I hope I don't do it again here this morning. Have you been watching the Swiss franc at all and some of the weakness we've been seeing there?
Not too much. Again, there's been a little bit of weakness across the Eurozone, and I'm not sure that's bleeding into the Swiss franc or not. That's not one of the currencies, though, that we keep an eye on. We keep an eye on more of the major ones, and the strength really there has been the dollar and actually the Japanese yen. But the Swiss franc's been kind of off our radar for a while.
Well, the yen was where I was heading next. Paul, talk to us, because I've been keeping a close eye on it with the NASDAQ into new all-time highs. I would think that the yen would be a little bit weaker. We've got the dollar up to 97 in the overnight session. What's holding this yen up? I mean, where's the strength coming from?
It's interesting because the data coming out of Japan is actually a little bit better. There's actually no longer talk of deflation. They're certainly not talking inflation. But the data points that we're seeing out of Japan are a little bit stronger here. We're getting close to at least coming out of negative territory for their interest rate market. So again, that's a little bit more of supportive of the yen here. Keep an eye on their bond market as far as being able to push maybe their yen a little bit higher. So I think really when you're looking around the globe, you really want to be focused in on the interest rate market, and I think the interest rate market is going to dictate what happens in the currency markets as opposed to the other way around.